Ever wonder how a company transforms something like, future loan payments into actual cash they could use today?
It's a fascinating process.
Yeah, and that's the world of asset securitization we're plunging into. And look, for you as an Upstart shareholder, understanding this is really, really crucial.
Absolutely.
It's basically how Upstart fuels its growth, manages risk, and, well, ultimately impacts your investment.
Precisely.
Wow.
And our aim in this deep dive is to unpack the mechanics, the nuts and bolts and the strategic thinking behind asset securitization.
Specifically relating it back to a company like Upstart.
Exactly. We'll be drawing on the core principles of asset-backed securities, the established knowledge, to give you a clear view of what's actually happening.
Okay, and this isn't just abstract theory, right? We're grounding this discussion. So let's get right into it. Chapter 1 stuff first, I suppose. What is asset securitization? Fundamentally.
Simply put, it's the process of taking assets that aren't easily traded. Think loans, credit card balances, maybe even car leases.
Things that are kind of locked up.
Right, non-liquid assets, and bundling them together to create new tradable securities that investors can buy and sell.
Okay, so Upstart originates loans. Not easy to sell one by one. Why go through all the trouble, the complexity of securitization? What's the real payoff for them?
Well, there are some really compelling advantages. First, it's a smart way to manage their capital, economizing capital, as the source puts it.
How so?
When Upstart securitizes loans, they can often move these assets off their balance sheet, especially the ones regulators might see as higher risk, requiring more capital held against them.
Okay, so it frees up that capital.
Exactly. It frees up capital for them to, originate even more loans. Think of it like recycling their capital faster, more efficiently.
That makes immediate sense. Less capital tied up, more available for growth. Okay, what else? What's another key driver?
It can also be a cheaper way to get funding. Sometimes, anyway.
Cheaper than just borrowing money normally.
Potentially, yes. Imagine a company, maybe it has a decent credit rating, say BBB, but not top tier. By packaging specific, good quality assets as collateral.
Like these loans.
Right. They might be able to issue securities backed by those loans that get a higher credit rating, maybe even a AAA.
Wow, okay.
And that higher rating translates directly into lower borrowing costs for them. It's the quality and expected cash flow of the assets that investors are looking at, more so than the company's overall rating.
So the loans themselves secure the borrowing at a better rate. Got it.
Precisely. And there's a third key point, managing mismatches, asset liability mismatches.
What does that mean in practice?
Well, think about a traditional bank maybe funding long-term home equity loans with short-term customer deposits. There's a risk there, right? If short-term rates go up, their funding costs rise, but the income from the long-term loans stays fixed for a while.
Yeah, that sounds risky. Interest rate risk.
Exactly. Securitization lets them package those long-term loans into securities with different maturities or interest rate structures. It helps them better align the timing and repricing characteristics of their assets and liabilities, which mitigates that interest rate risk.
Okay, so main motivations, free up capital, potentially get cheaper funding, and manage those asset liability timing risks.
Makes sense. Now, how does this transformation actually happen? The mechanics.
Okay, so the core of it involves a few key steps and this special entity called a special purpose vehicle, or SPV.
SPV, okay, I've heard that term. Sometimes called a bankruptcy remote entity, too.
That's right, and that bankruptcy remote part is critical.
Why is it so important?
Well, the SPV is legally separate from the originator, from Upstart in this case. It's set up just for this securitization. Its whole purpose is to buy and hold that pool of loans being securitized.
And by being legally separate, it isolates those loans from Upstart's own financial risks. So if hypothetically Upstart faced financial difficulties, the assets safely held in the SPV are protected. They wouldn't be dragged into Upstart's potential bankruptcy proceedings.
It's like building a legal firewall around those specific loans, protecting the investors who buy the securities backed by them.
Exactly. And a crucial element to make this legally sound is the concept of a true sale.
True sale.
Yes. The originator, like Upstart, must legally sell the assets to the SPV. It's not just handing over the servicing. It's a real transfer of ownership. This is key for achieving that bankruptcy remoteness.
Got it. So the SPV buys the loans. It's legally separate. Investors are protected. Now, the source material covers a lot of asset types, but as someone thinking about Upstart, I'm particularly interested in how this applies to things like credit card receivables or maybe similar unsecured loans. Chapter 3 focuses on credit cards, right?
It does, and it's a very relevant comparison point. Credit card receivables, much like unsecured personal loans, have specific cash flow characteristics that are really important when you securitize them.
Okay, like what? What are the key metrics or features?
One really crucial one is the monthly payment rate, or MPR.
MPR,
It's
monthly
the-
payment rate.
Yeah. It's the percentage of the total outstanding balance that cardholders pay back each month, on average. It tells you how quickly the principal is coming back in.
And why is that so important?
Well, it impacts the expected life of the security, and as we'll get into later, a big drop in MPR can actually trigger an early repayment of the securities. It's an early warning sign, potentially.
Okay, MPR, speed of repayment.
Yeah.
Got it. What else?
Then there's the portfolio yield. And this isn't just the interest rate borrowers are paying.
Right, it's broader than that.
Much broader. It includes all the income from the portfolio, the interest, yes, but also things like interchange fees.
The fees stores pay when you use a card.
Exactly. And maybe annual fees, late fees, servicing fees charged to the portfolio. So you can think of the gross portfolio yield as something like coupon interest plus interchange plus other fees. It's the total revenue generated by those assets.
The total income stream.
Right. But to see the profit, you need to subtract the costs. The main ones are charge-offs loans deemed uncollectible.
Defaults.
Defaults, essentially. And the originator's own cost of funds, let's call it the base rate. So gross portfolio yield minus charge-offs minus the base rate gives you the excess spread.
Excess spread, and that's like the cushion.
Exactly. It's the profit margin generated by the assets themselves, and it's the first line of defense to absorb unexpected losses. A healthy excess spread is vital.
Makes sense. Speaking of losses, how is that credit risk, the risk of people not paying back, assessed and managed specifically for, say, credit card type receivables?
Yeah, credit loss assessment is absolutely critical. Charge-off rates are the key indicator here. Usually an account gets charged off after it's been delinquent, maybe 180 days past due. And the level of those charge-offs depends heavily on things like, how were these borrowers acquired in the first place? What were the underwriting standards? The credit scoring used? And importantly, how effective are the collection procedures?
So better underwriting and collections should lead to lower charge-offs.
Definitely. It all ties back to the quality of the origination and servicing. Now, for credit cards specifically, you often see something called a master trust structure.
Master trust, what's that?
It's a common structure where a bankruptcy remote subsidiary, that SPV we talked about, holds a large, often changing pool of receivables. Then, interests in that trust are issued typically investor certificates and seller certificates.
Investor certificates and seller certificates, how do they differ?
The investor certificates are what get sold to outside investors. The seller certificate, that represents the originator's, like Upstart's, retained interest in the pool. Its value is basically the total amount of receivables in the trust minus the amount of investor certificates issued.
And what's its function?
It usually acts as the first loss piece. It absorbs fluctuations and initial losses in the value of the receivables pool. So Upstart keeps some skin in the game, which helps align their interests with the investors who bought the certificates.
Okay, so Upstart retains a piece that takes the first hit if things go wrong,
Yeah.
aligns incentives. Right, moving on. Chapter 15 talks about actually building these ABS transactions effectively. What goes into that?
Building an effective ABS transaction is, well, it's complex. It's about structuring the deal to meet a whole bunch of requirements simultaneously.
Like what?
Legal requirements, tax rules, accounting standards, JAP specifically, and of course any relevant regulations. It's a balancing act.
Sounds tricky. What's the main goal of all that structuring?
The main goal is really to allocate the risks and the returns from that pool of loans efficiently among everyone involved, the issuer, like Upstart, and the different types of investors buying the securities.
So if we're evaluating Upstart's securitizations, understanding the specific structure they use is key to judging how well they're actually managing risk and optimizing the deal for themselves and investors.
Absolutely. The structure tells you a lot. And this structuring process usually involves investment banks, the underwriting firms.
Right? They help design and sell the securities.
Exactly. They help structure the deal, figure out the pricing, and then distribute the securities to investors. But that comes with costs. Of course, banking fees, legal fees, distribution costs.
Makes sense. Does it matter if the loans are, say, conforming versus non-conforming?
It can. Conforming assets, those meeting certain agency standards, might have more standardized structures and potentially easier distribution. Non-conforming assets, which might include some of Upstart's loans, often require more customized structuring.
And I imagine this whole process must feed back into how Upstart operates.
Oh, definitely. There's a feedback loop. The process of securitizing, seeing how the market prices different risks, highlights the costs associated with certain loan characteristics. Well, if loans with certain features consistently need more credit enhancement to get a good rating, or if they trade at lower prices, that tells Upstart something about the market's perception of that risk.
So they might adjust their lending based on that feedback.
Exactly. It can influence their future underwriting, who they lend to, maybe even how they service the loans. It's a continuous learning process.
Interesting. So, okay, the ABS is structured and sold. Now, investors need to trust it. That brings us to the rating agencies, right? Chapter 16. How do they evaluate these things?
Right. The rating agencies play a huge role. Their ratings are a crucial signal of credit quality for investors. It heavily influences whether investors will buy the ABS and at what price.
What do they look at? What earns a good rating?
They look at several core things. First, obviously, the credit quality of the underlying assets, the loans themselves, historical performance, borrower characteristics, diversification, future expectations.
Makes sense. What else?
Second, and this is really important, the quality of the originator and the servicer. So Upstart's track record.
What about their track record?
Their production volume, their historical delinquency and loss experience on similar loans, their underwriting standards, the sophistication of their servicing systems, quality control. Basically, how good are they at originating and managing these types of loans? A strong track record helps a lot.
So Upstart's operational quality matters directly for the ABS rating.
Absolutely. Then the agencies run cash flow stress tests.
Stress tests, like simulating bad economic times.
Exactly. They model harsh scenarios, recessions, higher unemployment, interest rate spikes, and see if the ABS structure can still make its payments to investors even under that stress. They want to see resilience.
So they're not just looking at the base case, they're testing the buffers.
Right. And finally, they scrutinize the legal structure. They need to be confident about that bankruptcy remoteness we discuss, and that all the rights and obligations are crystal clear and legally sound.
Okay, so it's assets, originator quality, stress resilience, and legal structure. Got it. Now, let's spend some real time on Chapter 17. This seems critical. Credit enhancement. Making the ABS safer for investors.
Yes, credit enhancement is absolutely central. It's all about reducing the credit risk for ABS investors, making it more likely to get paid back fully and on time, even if some underlying loans default.
And the source mentions internal and external methods.
Correct. You can build protection into the structure itself, that's internal enhancement, or you can bring in support from an outside party, external.
Okay, let's break down the internal methods first. What's the most common one?
Probably the prioritized or subordinated structure, often called senior subordinated, or sometimes just senior sub.
How does that work?
You divide the ABS issuance into different classes or tranches. You'll have senior tranches, which have the first claim on the cash flows, and then one or more junior or subordinated tranches below them.
And the junior ones take the hit first.
Exactly. Losses from the underlying loan pool are absorbed first by the most junior tranche, then the next junior, and so on. This protects the senior tranches. The size of those junior tranches determines the level of protection or credit enhancement for the senior notes. Paydown rules also affect how this protection evolves over time.
So investors can choose their risk level. Senior for less risk, junior for potentially higher returns but taking the first losses. Smart. What else internally?
Another key one is over-collateralization, or OC.
Over-collateralization. More collateral than securities.
Precisely. The total principal amount of the underlying loans in the pool is greater than the total principal amount of the securities issued. So say you have $105 million in loans backing $100 million in securities.
That extra $5 million is a buffer.
It's an immediate cushion against losses. And an interesting benefit for issuers using OC is that the excess spread generated can often be reinvested at the rate earned on the collateral itself, which can be attractive. One potential effect, though, is that principal might get repaid to investors faster, leading to tighter principal windows.
Okay, so OC provides a direct buffer. What else? You mentioned excess spread earlier.
Right. Using that excess spread itself is a form of internal enhancement. You can structure the deal so that this excess spread, the difference between income and expense investor payments, is trapped in a spread account or reserve account.
Like a rainy day fund built from the deal's profits.
Kind of, yeah. If losses occur, money can be drawn from this account to cover them before hitting the subordinated tranches or causing defaults on payments. Excess interest or excess servicing works similarly. It's basically any cash flow left over after paying investors and fees, providing another layer of cushion.
So internal methods are tranching, senior sub, over-collateralization, and using the deal's own excess cash flow. Spread accounts excess interest.
Got it. Now, what about external credit enhancement, bringing in outside help?
Right. This involves a third party providing some kind of guarantee. The classic example is insurance, usually from a specialized monoline insurance company.
How does that work? A highly rated insurer guarantees the timely payment of interest and principal on the ABS. This insurance wrap can significantly boost the rating of the security, potentially up to the insurer's own rating.
But the value of that insurance depends on the insurer staying strong, right?
Absolutely. The insured rating is only as good as the insurer providing the guarantee. If the insurer gets downgraded, the ABS rating can fall too.
Okay, insurance is one way. Any others?
Letters of credit, LOCs, are another form, usually from banks. They provide a guarantee up to a certain amount, but they're perhaps less common now than they once were for some types of ABS.
Got it. So external relies on a third party's strength. The outline also mentions residual value. Is that relevant here for upstarts loans?
Residual value is mostly a factor in deals backed by assets that have a predictable value at the end of a contract, like car leases or equipment leases. It's the estimated value of the car or equipment when the lease ends.
And how is that credit enhancement?
Because if the lessee doesn't buy the asset, the issuer can sell it, and that residual value helps cover the remaining loan balance. So it adds security. It's less directly relevant for unsecured personal loans like upstarts, which don't have a tangible asset to repossess with significant resale value, but it's part of the broader ABS toolkit.
Understood. Okay, so we have ways to make ADS safer. But what happens if things start to go wrong with the underlying loans? Chapter 18 talks about early amortization. What's that about?
Early amortization, sometimes called early payout or a trigger event, is basically a safety mechanism. It means the principal of the ABS starts getting paid back to investors sooner than originally scheduled.
Why would that kick in? What triggers it?
A number of things, usually related to deteriorating performance of the underlying assets. For example, if defaults or credit losses in the loan pool rise above a preset threshold.
So if too many borrowers stop paying...
Right. Or, for assets like credit cards, if that monthly payment rate, the MPR, drops significantly and stays low. That signals borrowers are struggling or paying back slower than expected. The source mentions the historical case of Southeast Bank Credit Card Trust, where declining yield triggered it.
Okay, so bad performance can accelerate repayment. What else?
Other triggers could be things like significant changes to the nature of the cash flows, the bankruptcy or downgrade of a credit enhancement provider, like that insurer we mentioned.
If the insurance backing disappears.
Exactly. Or if the servicer, the company managing the loans, defaults on its duties. Or even, as the chapter title hints, if there's a very large increase in loan modifications.
Loan modifications. Why would that be a trigger?
Well, a surge in modifications might suggest widespread borrower distress or that the original expected cash flows are changing significantly. It could be seen as a negative signal about the pool's health, potentially triggering early amortization to protect investors.
So these triggers are like tripwires. If certain negative events happen, the deal starts winding down early to get investors' money back faster. That seems really important for an investor to understand.
Absolutely critical. Early amortization significantly changes the expected life and yield of an ABS investment.
Yep.
You need to know what could cause it.
Definitely. Okay, final major piece. The accounting, Chapter 25. How does a company like Upstart actually account for these securitizations on its own books?
Yeah, this is key for understanding their financial statements. Under GAAP, there are broadly two ways: sales treatment or financing treatment.
Sales versus financing. What's the difference in simple terms?
With sales treatment, if the deal meets certain strict criteria, Upstart basically gets to remove the securitized loans from its balance sheet. Poof, they're gone.
And that affect their financial ratios.
Significantly. Fewer assets reported, potentially better-looking capital ratios. The key is whether Upstart has truly given up control over the assets. They generally can't retain significant rights, like the ability to buy back the loans whenever they want, except for a limited thing called a cleanup call.
Cleanup call. What's that?
It's usually an option for the servicer, often Upstart, to repurchase the remaining loans in the trust when the outstanding balance gets really small, say 5% or 10% of the original amount. At that point, it's just not efficient to keep the whole complex structure going for such a small amount.
Okay, so sales treatment, assets off the balance sheet, mostly. What about financing treatment?
With financing treatment, the assets stay on Upstart's balance sheet. The transaction is treated essentially like a secured loan. Upstart borrowed money, And the securitized assets are the collateral for that borrowing.
So the debt shows up as a liability and the loans stay as assets. How do they decide which treatment to use?
It depends entirely on whether the specific transaction structure meets the strict accounting rules for a sale. If it doesn't meet those rules, it has to be treated as a financing. And the choice or requirement has big implications for their reported assets, liabilities, debt levels, and even income recognition.
And briefly, what about the investors buying these ABS? Any accounting points for them?
Yes, investors have rules too, often under standards like SFAS 115 back in the day or current equivalents. They classify these securities maybe as held to maturity if they plan to hold them long term, trading if they actively buy and sell, or available for sale somewhere in between.
And that affects how they value them on their books.
Right. Held to maturity might be at amortized cost, while trading securities are usually marked to market, reflecting current fair value. Available for sale has its own nuances. It depends on the investor's intent.
Okay, accounting is definitely complex, but clearly important for reading the financial story.
It really is. It shapes how the impact of securitization shows up in the numbers.
Well, this has been incredibly helpful, a real deep dive. As an Upstart shareholder, I feel like I've got a much better handle now on why they securitize. The capital, the funding, the risk management.
Their motivations are key.
And the mechanics, the SPV, the true sale. Then understanding the specifics for loan types, the structuring, the ratings, and especially all those layers of credit enhancement.
Internal and external, yeah.
Plus the early amortization triggers and the accounting side. It provides a really strong foundation for evaluating what Upstart is doing here.
Absolutely. Understanding these pieces helps you assess their strategy, the quality of their securitized products, and how it all flows through to their financial performance. That accounting piece gives you real insight into how they present these activities.
Okay, so let's leave our listeners with a final thought to chew on. Given all these complexities we've discussed, the structuring, the enhancement, the triggers, what specific metrics or disclosures should you, as a discerning Upstart shareholder, really focus on when you look at their reports? What tells you if their ABS activities are truly effective and how risky they might be?
That's the critical question, isn't it? It pushes you to look beyond just the headline numbers. You'd want to dig into details on the performance of the underlying loans in their securitizations, delinquency rates, loss rates, maybe even prepayment speeds. Look for information on the amount and type of credit enhancement they're using in each deal. Are there signs of stress that might point towards those early amortization triggers?
So looking for the trends in loan performance within the ABS, the level of protection built in.
Exactly. Getting comfortable with those details gives you a much richer, much more informed perspective on a really important part of Upstart's business model.